Good day, everyone. Welcome to our confidential report for December 2021. This will be our last confidential report for the year, and the next one will only be done on the 2nd of February next year, the first Wednesday of February next year in 2022. All right, let us begin as usual with America. The US economy is booming, of course. Jobless claims have come down by 71,000. And consumer spending was up 1.3% in October alone. Third quarter GDP was only 2.1%, but that was mainly because of the supply constraints, which I'm sure you've seen about in the news. But this 2.1% was definitely ahead of analysts' expectations. The unemployment rate in America has dropped to 4.6% now, and it's closing in on that full employment level. You know, economists talk about full employment at just below 4%. So when you get full employment in an economy, then generally wages start to rise. So full employment is inflationary, or supposed to be inflationary at least. Consumers are spending with abandon, and despite or because of inflation. Fourth quarter growth estimates are very much higher. JP Morgan is expecting growth of 7% in the fourth quarter. Morgan Stanley is talking about 8.7%. Even the Atlanta Fed came out and predicted 8.6%. So the year is going to end with a bang. This surge, of course, was entirely predictable, the surge in consumer spending. It comes from ultra-low interest rates plus massive quantitative easing. The normalizing of the economy, in other words, the reduction of quantitative easing and the raising of interest rates, was just about to begin when the pandemic hit. The Fed, of course, began a new schedule of quantitative easing and kept interest rates at ultra-low levels. In fact, over the last 18 months, the Fed has injected $11 trillion into the US economy. It's not surprising that consumers are spending more. Of course, before interest rates can start to go up, quantitative easing must end. The Fed has announced tapering, which means reducing the amount of quantitative easing from its current level at around $120 billion a month by $15 a month each month from here on. Obviously, if you do the calculations, that means that quantitative easing should end in about June next year. Only then can rates begin to rise. So the announcement of tapering had almost no impact on the markets. For the market to take fright, the rates need to rise at least to the point where they start to impact corporate profits. And at this stage, we seem to be relatively far from that point. But inflation in America remains high. In fact, it's been over 5% for more than 6 months now. This no longer looks like base effects from the depressed 2020 year. Now the inflation rate is 6.2%. The oil price is rising, and that is partly to blame. Also rising food prices. Of course, the reappointment of Jerome Powell as the governor of the Federal Reserve Bank has had an impact. He is seen to be more hawkish. In other words, he is likely to accelerate tapering and possibly to begin the raising of interest rates more aggressively or more quickly. But in general, I think everyone is very happy that Jerome Powell is back in the driving seat. The major factor, though, in America at the moment is fears of a fourth wave of the virus based on the new variant, Omicron. Germany has recorded 78,000 cases in a single day. But we don't know if those are Omicron cases or not. Maybe they're just Deltas. On Black Friday, that's last Friday, the 26th of November, there was a massive sell-off on the S&P 500. In fact, the S&P was down 2.27%, and the Financial Times 100 index fell 3.7%. Brent oil came off 10%, and in fact even broke the lower channel line. Of course, markets are high, and they were looking for an excuse to correct. Omicron provided a reason. If you look at the chart on your screen here, you can see that the previous record high was over here on the 2nd of September at 4536. We're looking at the S&P 500. And now we went down in a little correction there and rose up. The last confidential report was here, so we were breaking new record highs at that point. And then the market sort of moved sideways for a while with a record high on this day here, which was the 18th of November, and that was at a level of 4704 on the index. And then, of course, the market came off. Here is the Black Friday sell-off, which was stimulated by fears of a revival in the virus and the fourth wave. And last night, we had another 2% drop. So obviously the fears are not out of the system yet. There was a suggestion that the Omicron virus or variant is not susceptible to the vaccinations which have been put out there, and that obviously scared the market quite a bit. And of course, Jerome Powell also was talking about tightening interest rates more quickly, and that also had a negative impact on markets. But we regard this as a technical aberration, similar to the V bottom that occurred in March last year when the virus first hit. The virus is not an economic factor. It's not linked to investor psychology. It's a black swan event. It's unpredictable, and it doesn't really impact on the technical analysis of these charts. Nonetheless, the market is now falling. The S&P 500 is now falling. And as you know, we have been predicting that there would be a major correction at some point. We predict that it will be in the range of 10 to 20%. However, we don't think that this is it. We don't think this is that major correction. We believe that this is an aberration, a once-off, and that it will quickly reverse itself once the markets stabilize and there's more information about Omicron. So that again means that this is probably a buying opportunity. So our message to you is more or less similar to what it was over here in October, that this downward trend was a buying opportunity. It wasn't the beginning of a major correction. We feel that this is the same sort of situation. All right, let's turn our attention to South Africa. Obviously, in the last month, since last month's confidential report, we've had the election results, and those results point to a turning point in South Africa. They are a major turning point in this country. Voters have basically abandoned the ANC, the revolutionary party that got rid of apartheid. They're no longer voting in favor of that party simply because they are the revolutionary party. Now voters are looking for more. They're looking for the delivery of services. That's really what they're looking for. And the loss of support for the ANC has opened doors for other parties to come into the fore. And most notably, Action SA has come to the fore with a very strong support. The ANC, of course, lost key metros, in Gauteng particularly, and perhaps this is a precursor to the next election in 2024-25. Maladministration and the corruption in the municipalities are undoubtedly the ANC's greatest weakness. Of course, the vulnerability of the ANC reduces South Africa's political stability, especially as far as overseas investors are concerned. They will tend to be more cautious, and that is part of the reason why the rand has weakened so strongly in the last few weeks. Municipal councillors will no doubt feel a little less secure in their positions in the future, and maybe that will encourage them to perform better than they have. Let us look now at the economy. The midterm budget policy statement came out. It was Godongwana's new first budget as Minister of Finance. It was very comfortingly conservative. Godongwana appears to be being very sensible. That helped to calm markets down. It's apparent that he's not radical. He's not a populist. And of course, he did have the advantage of a massive commodity windfall. Tax revenues were about 120 billion more than had been expected in the February budget, and most of that money was used to pay down the government debt. Of course, ratings agencies and international investors are watching Godongwana very closely to see what he does. The national debt, in fact, has become a measure of South Africa's progress and reforms. Luckily, of course, the economy has recovered much faster than was expected. Official estimates of GDP growth for 2021 are now at 5.1%. They've been increased from 3.3%. The midterm budget policy statement estimates that in 2022 and 23, the growth will be a very conservative 1.8%. Of course, they are taking into account the load shedding, which has suddenly started again. However, we think that 1.8% is very conservative, and we expect the growth rate to be somewhat higher than that, both in 2022 and 23. Godongwana's refusal to include money in the budget for bailouts of the state-owned enterprises is good. He pointed out that we have injected 290 billion rand into state-owned enterprises since 2013. That money could have been spent building houses or providing services for the most destitute people in South Africa. The Deputy Finance Minister took this idea a little further, and he questioned the strategic relevance of some of the SOEs. He said that we need to have a debate on whether private enterprise should fill in the gaps. Of course, private enterprise has been doing this ever since 1994. I mean, if you look at the education in this country, basically the collapse of government education has made it possible for companies like Curro to offer education on a wide scale in the country. It's also true of healthcare, where government hospitals have really declined substantially and have been replaced by private hospitals. The same can be said of security, where the inadequacy of the policing has led to a boom in private security companies. Of course, all of this is skirting around the political hot potato of privatization. And nobody's actually saying that word, but that's kind of where this debate is headed. They're looking at getting support from private enterprise to run some government functions which are currently costing them money through bailouts every year. Of course, there's no doubt that Godongwana will have to put more money into Eskom, but he has shown that he can oppose the pressure from the unions and from other government members to spend. And that pressure must have been even greater after the ANC's poor election showing. The midterm budget policy statement expects that commodity prices will continue to be high, but its estimate of future windfalls is also conservative. We expect commodity prices to continue rising as the world economy recovers. China, of course, has become the workshop of the world, and we supply raw materials to China. The government is making it difficult for our mining companies by obstructing the mining industry with various different types of idealism and bureaucracy, not to mention the inadequacy of the ports in this country. The producer price index jumped 8.1% in October. That's up from September's 7.8%. Most of that was due to the fuel prices. Energy prices have been rising throughout the world, but of course the falling rand has made it far worse in South Africa. We're going to be looking at 20 rand a litre now for petrol. We believe that the rise in the CPI will move quickly, in the PPI, the producer price index, will move quickly through to the consumer price index, especially with load shedding. We've got rising food, beverage and tobacco prices, all of which are contributing to increased inflation. The Monetary Policy Committee, seeing this, has wisely, in our opinion, raised interest rates by 0.25% at its November meeting. And obviously they're trying to get ahead and stay ahead of the inflation curve. But despite that 0.25% rise, the bank's stance remains very accommodative. Rates are still relatively low, but the interest rate cycle is definitely turning. There will be more hikes in 2022 and 2023. The stability of the rand has kept the South African economy afloat during the Zuma years. He was never able to capture the Reserve Bank. And that, of course, is a major factor that benefits South Africa in these difficult times, is that our inflation rate is relatively low compared to other emerging markets. Of course, one of the negatives is the oil price. If we look at the oil price, I'm just going to change the chart here to show you that. You can see that although, I'm just going to put a bit more data on there, let's take it to 2 years. You can see there that although we've had a downward spike over the last couple of days, we are basically in an upward channel. In other words, the oil price is essentially rising. And we believe that that will probably continue in the near term once markets stabilize and once fears of the fourth wave diminish somewhat. Of course, the fourth wave represents a risk to South Africa as well. It may be that we have to go further into lockdowns, but we don't think that the fourth wave will be as bad as the third, mainly because a lot of people have had COVID in this country, therefore have some degree of immunity, and a lot of people have been vaccinated as well, about 35% of the population now. So we think that the impact will be there, but it will not be as severe. Of course, it will impact certain industries like tourism and hotels. But even that will probably be a short-lived impact, not nearly as bad as the first lockdowns. Let's turn our attention now to the rand. Just going to, wait a minute. Just going to put the rand dollar on the screen here so that you can see what I'm talking about. And we look at this chart every month, so I just want to go to 5 years. Here you can see the whole picture in quite a lot of detail. I'm just going back to the left-hand side of the chart. Over here you can see the effect of Ramaphoria after Cyril Ramaphosa was appointed as head of the ANC first, and then in February, of course, as president. And then that was followed by a period of weakness, which reached this support level at 15.30 Rand to the US dollar. Then it moved sideways for quite a while, and then there was the spike, which is related to COVID-19. So when international markets moved to risk off from risk on very sharply in March last year, and then from that, a long period of strengthening all the way through here to reach this strongest point here at 13.43 to the US dollar on the 4th of June 2021. After that, the market began to weaken again. The first thing, of course, was the cabinet reshuffle, and then there were fears about the election here in South Africa. Those were local factors, and then that was followed by fears about the fourth wave, leading to a break up through this support level at 15.30. So you can see here, there's a clear head and shoulders formation, and up with the neckline being at that 15.30 Rand level. And we've broken up through that, an upside breakout, and the rand is up here. So that's where we are right now. However, we believe that the rand will strengthen again. It did actually go back below 16 Rand to the US dollar. If I just quickly go into that chart, and you'll be able to see exactly where we are right this very second. Just trying to connect here, get that information for you. Okay, there you can see the rand has actually appreciated after moving sideways above 16 Rand for a while. It's appreciated quite sharply last night and this morning, and we're now down to 15.76. Which is, of course, good news. It doesn't save this month's petrol price, but it'll probably means that next month's petrol price will be a bit lower. So we're expecting the rand to continue strengthening. We believe that it is fundamentally underpriced against first world currencies, especially the US dollar. So we are expecting the rand to appreciate. Okay, let's now turn our attention briefly to Eskom. Of course, there was a burst of load shedding before and after the election, and the unions were calling for Durator to be fired, to be made the fall guy for all this, but of course that won't help anything. Bringing in a new CEO or a new board at this stage will not change the situation at Eskom. I believe that Durator is doing a good job, but it's a virtually impossible task. And that was part of the reason why the ABSA Purchasing Managers Index for October fell to 53.6, down from September's 54.7. Eskom and load shedding are a major impediment to economic growth. And of course, to that, you must add the 8-day metal workers strike, which we had, which is now over, thank goodness. Vehicle sales fell, and in fact, in October month, vehicle sales were just 6% higher than last year's very depressed production levels. But that is, of course, because of the metal workers strike, and something to do with load shedding as well. We believe that Eskom is slowly dying. Ancient power stations, which keep on failing, and the operation, the company is operating literally on a wing and a prayer. It's a deadly corruption, a cocktail of corruption, indolence, and incompetence, and it's not going to be quickly fixed. It's going to require decades, and it's going to require hundreds of billions of dollars, which Eskom really doesn't have. The government is still looking for a strategic partner for Eskom, somebody in the private enterprise who will come in and share the load. But of course, the debt is a huge problem. At least half of that debt will have to be moved onto the government's balance sheet, I'm pretty sure. Many smaller businesses are making their own plans for electricity now. They're taking advantage of the new dispensation to produce their own power. They want to avoid Eskom's increasingly expensive and unreliable supply. The mining industry has about 60 billion rand ready to invest in renewable energy, which is just waiting for government approval. That would produce about 3.9 gigawatts of power and would resolve most of our load shedding problems very quickly. The concessional financing, which has been negotiated, is 131 billion rand. It's coming from the UK, France, the US, and Germany. We're getting this money with very low interest rates. And RMB, Rand Merchant Bank, says that the 131 billion could be leveraged up to about 390 billion with investment from the private sector. Of course, it is money to be spent on renewables. We can close about 7 or 8 of our oldest coal-fired power stations, and we can use the money to build new renewable energy production and also to improve our transmission system. But a major factor in South Africa is going to be the provision of electricity. However, in our opinion, business is moving very rapidly towards becoming free of Eskom and making their own arrangements for power. Okay, a few general points here. Heineken, of course, has agreed to buy 100% of Distel now for 40 billion rand. That's a massive vote of confidence in South Africa's long-term future. It, of course, is a big step in the direction of Ramaphosa's goal of building up foreign direct investment, and it's a huge injection of capital. Remgro, of course, owns 31.7% of Distel, so there will be a capital injection over there. And it should unlock some value for Remgro shareholders. About 40% of South Africa's credit-active population are impaired. So South Africa has about 40 million people who are credit active. Roughly half of those are impaired, which means that they're at least 3 months behind on the repayment of their debt. This number has dropped since June. It was 45% in June, and in 2019, before the pandemic, it was 43%. So it shows that South Africans are responding to the lockdowns and to the pandemic by paying off debt. Black Friday sales were down, quite surprisingly. Consumers are clearly being more careful. Another point that's raised this month is the post office. Death of the post office seems inevitable now. Its income has dropped from about 3.4 billion rand in 2015 to about 1.5 billion rand now. And they asked the government for an 8 billion rand bailout, but Godongwana put nothing in the MTBPS for them, the midterm budget policy statement. There was nothing for the post office at all. Instead, he talked about tough love. Of course, the post office's role has largely been taken over by the internet on the one hand, and also by Postnet and similar services on the other. Another statistic that came out that crossed my desk, which I found amazing, is that South Africa has 1,300 government-owned buildings that are illegally occupied throughout the country in all the major centres. This demonstrates the inability of this government to manage its assets and control its resources. Removing squatters now from these buildings is going to be very difficult and very politically sensitive. In fact, informal settlement is on the rise. There are about 50 new squatter camps in Cape Town alone since March last year, since the beginning of the pandemic. So that gives you an idea of what's going on there. All right, let's turn our attention to some companies now. Let's go back to ShareFriend. The first one I want to talk about is Renogen. Renogen is interesting because up until the beginning of October over here on this chart, if you look at this chart, you can see the top part of the graph is a candlestick chart. The second graph, the middle one, is an on-balance volume chart, and the bottom chart is a volume histogram with this black line representing a 30-day moving average of the volumes. So what you see here is that at the beginning of October, around here, roughly 125,000 shares of Renogen were trading each day. Volumes then began to increase with small increments in price. You can see the price of the share started to go up with rising volumes. That led to an on-balance volume buy signal over here, roughly there at 23.90 on the 14th of October, 23.90. Since then, the share price has spiked all the way up to 4,076, which is a massive gain. So it gained about 70% in 13 days. So this shows you the importance of the on-balance volume technique for picking up insider trading. This kind of pattern where you've got very strongly rising volume with small increments in price is a classic insider trading sign. So as soon as you see something like that, you can buy the share. You may not know what's going on, but the insiders obviously do, the people who are inside the company. All right, so then let's look at Purple Capital. Purple Capital is an interesting company. They have a trading platform and they do asset management. Just want to put a bit more data on the screen here. Okay, there we go. You can see that Purple Capital was in a sideways market. They are best known for their company Easy Equities, which has recently formed a joint operation with Capitec. And they say that they are signing up 60,000 new accounts every month, most of whom, about 95% of whom, are first-time investors. You can see here there was a sideways market, but we had an upside break over there on the 29th of May 2020 last year at about 43 cents. And since then, the share has been accelerating. You can see from these trend lines that accelerated upward move. And it's now trading for about 227 cents and rising. Harmony Gold Mine. Harmony Gold Mine is a marginal gold mine. Okay, that means that its cost of production is very close to the current gold price. In fact, the all-in sustaining cost of Harmony's gold production is about $1,691 per ounce. So you can compare that to the gold price, which is about $1,787. So their profit per ounce of gold is less than $100 and could easily be wiped out by a small move in the gold price. So a marginal gold mine like this, the profitability goes up and down very rapidly as the gold price moves, which makes it very volatile. But Harmony is recently bought the Mponeng gold mine from Anglo, and that's the world's deepest mine. And they're building a 30 megawatt solar park with plans to extend that to a further 80 megawatts. We advise clients to wait for a break up through this long-term downward trend line, which you see on your screen. That break came over here on the 12th of October at 54.58 cents. And the share has now moved up quite sharply, and it's trading for 60 Rand and 46 cents. Sorry, that's not quite correct. It's trading for 62 Rand and 49 cents. So it's gained about 18% in a relatively short space of time, about a month and a half. So that's Harmony. Obviously, Harmony is volatile and it's speculative. You need to bear that in mind if you're looking at buying a share. The next share I want to talk about is Shoprite. Of course, everybody knows Shoprite. It's the largest retail grocery outlet in Africa. And they recently bought Cambridge and Rhino Foods from Massmart. Let's put a bit more data on the screen here. Okay, we advised people to buy this share when it broke up through its 200-day moving average. There was a clear upside break over here. And since then, the share has been moving up very nicely. So initially, the price fell from 275 Rand all the way down here. Made a bottom in July last year, and July this year, and it's been moving up. Broke up on the 12th of August. Sorry, that is July last year. Broke up on the 12th of August last year, and it broke up at 120 Rand a share, and it's now at 188 Rand over here a share. So it's gone up about 55% in 15 months since that upside breakout. Okay, the next share that I'd like to just talk about is storage. Storage is a property real estate investment trust. It's the only real estate investment trust on the South African Stock Exchange which specializes in storage facilities. So I just want to put more data on the screen here for you. You can see here, there's the COVID-19 downward spike, and since then the share has been trending upwards very steadily. We believe it will continue to do that. In the 6 months to the 30th of September 2021, the company's rental income rose by 11.6%, occupancy was at 86.8%, and the loan to value was 25%. That's a very low loan to value for a property rate, which shows that they've got a very strong balance sheet and they're very well positioned. We believe that this share has minimal risk and should continue to move upwards steadily. Okay, the next company is Omnia. Omnia, of course, is a diversified chemicals company. They mostly make their money from fertilizers, but they also make money from explosives. So they provide fertilizers to the agricultural industry, but they provide explosives to the mining industry. So they deal in 48 different countries around the world. In the 6 months to the 30th of September 2021, their revenue was up 30.2% and headline earnings per share more than doubled. Technically, the share was in a long-term downward trend, which you can see here. There was an upside breakout over here. We suggested you wait for this break up through the 200-day moving average. And that came in September 2020 at a price of about 62.76. Since then, there's been a gain of about 120% in the share's price over the last year. Last share I want to talk about today is PPC. PPC, obviously a leading manufacturer of cement, aggregates, ready-mix, lime, stuff like that. They've got 11 cement factories in South Africa, Botswana, Zimbabwe, Rwanda, Ethiopia, and other countries. Okay, let's just put a bit more data on the screen here again. There you can see that this share also was in a downward trend until November last year. And about a year ago, it broke up out of that trend, and since then it's been tracking up very steadily. Of course, they've benefited recently from the government's new localization policy, which requires all government departments to buy only locally produced cement. So they can't buy cement from imports from Pakistan, for example. This company, this share also gave a good on-balance volume buy signal on the 9th of December at 144 cents. So the share is trading at about 500 cents now, and it's gone up very, very strongly since this break up here over in November a year ago. So that's been a good investment. Okay, folks, that's about all I've got for you today. I'd just like to take this opportunity to wish everyone all the best for the festive season and for the new year. And just remind you that our next confidential report will be on the 2nd of February 2022. Have a good season.